When it comes to filing taxes, many Americans miss out on valuable tax deductions that could significantly reduce their taxable income. These missed opportunities often stem from a lack of awareness or misunderstanding of the tax code. The good news is that there are numerous deductions available to reduce your tax burden, and knowing what to claim can make a big difference in your overall tax bill. Here's a list of the top 10 most commonly overlooked tax deductions that many Americans forget to claim. 1. Student loan interest deduction. Many taxpayers who are paying off student loans may not realize they can deduct up to $2,500 of interest paid on student loans from their taxable income. This deduction applies to both federal and private student loans and is available to those who earn less than a specified amount, currently around $85,000 for single filers and $170,000 for married couples. If you're still paying off student loans, make sure to claim this deduction to reduce your taxable income. 2. Medical and dental expenses. While medical and dental expenses are not deductible unless they exceed a certain threshold, 7.5% of your adjusted gross income in 2025, many people forget to include smaller, qualifying expenses. These can include insurance premiums, prescription medications, and even medical travel costs. Keeping track of these expenses throughout the year can add up and help you meet the necessary threshold to claim this deduction. 3. State and local taxes, SALT. Many people overlook the SALT deduction, which allows you to deduct state and local income taxes, property taxes, and sales taxes, up to a $10,000 limit for individuals and married couples. If you live in a state with high income or property taxes, this deduction can be especially beneficial. Make sure to track all applicable taxes throughout the year, as this can significantly reduce your taxable income. 4. Home office deduction. For self-employed individuals or those working remotely, the home office deduction is often overlooked. If you use part of your home regularly and exclusively for business purposes, you may qualify for a deduction based on the percentage of your home that is used for work. This can include a portion of your rent or mortgage, utilities, and even repairs. However, it's essential to keep accurate records to substantiate this deduction. 5. Charitable contributions. Many taxpayers forget to claim deductions for charitable contributions, especially for donations of goods or clothing. In addition to cash donations, you can deduct the fair market value of items donated to qualifying charities. Make sure to keep receipts or bank records of any donations, as well as detailed records of the items donated, to ensure you get the maximum possible deduction. 6. Child and dependent care credit. If you pay for childcare or care for other dependents while you work or look for work, you may be eligible for the child and dependent care credit. This credit can be worth up to 35% of qualifying expenses, depending on your income. Many people overlook this credit, which could be worth hundreds or even thousands of dollars, so don't forget to claim it if you have qualifying dependents. 7. Mortgage insurance premiums. If you're paying mortgage insurance premiums as part of your home loan, you may be able to deduct these premiums as part of your itemized deductions. This deduction is available for both conventional loans and government-backed loans such as FHA and VA loans. However, this deduction is often overlooked, especially for new homeowners or those who refinanced their homes. 8. Educator expenses. Teachers and educators who spend their own money on classroom supplies may qualify for a $250 deduction for unreimbursed expenses. If both spouses are eligible, this deduction can be as much as $500. It applies to classroom supplies, books, and even computer equipment purchased for educational purposes. Many educators forget to claim this, so it's worth reviewing your expenses before filing. 9. Retirement contributions. Contributions to certain types of retirement accounts, such as traditional IRAs and 401ks, are often overlooked when it comes to tax deductions. These contributions can reduce your taxable income for the year in which you make them, and many taxpayers fail to maximize their contributions. Be sure to check the contribution limits and ensure that you're taking full advantage of the tax benefits available through retirement savings accounts. 10. Job search expenses. If you're looking for a new job in your current occupation, you may be able to deduct certain job search expenses, including resume preparation, employment agency fees, and travel expenses related to job hunting. While this deduction was temporarily suspended for tax years 2018 to 2025 under the Tax Cuts and Jobs Act, certain exceptions apply, such as if you're looking for a job in a new occupation or business. Keep any related receipts to claim this deduction if eligible. Tax season doesn't have to be overwhelming if you know which deductions to claim. Many common deductions go unclaimed simply because taxpayers aren't aware of them or forget to keep the necessary documentation. From student loan interest and home office deductions to charitable contributions and job search expenses, the opportunities to reduce your taxable income are plentiful. Be sure to consult with a tax professional or utilize tax preparation software to ensure you're maximizing every possible deduction and minimizing your tax liability.